Welcome to Fintech Talks. Um, Jay, if you wouldn't mind, please introducing yourself.
Thanks for having me. I'm Jay Levy. I'm a partner at Zelkova Ventures. We're an early stage venture fund that's focused primarily on B2B SaaS, fintech, at the very, very early stage. So we like to be part of the first checks in. We've been around for about 19 years. We've invested in about 130 companies. We're also investors in 12 different venture funds and incubators. So we have a kind of broad breadth within the early stage SaaS industry.
Amazing. Obviously we've known each other for about 20 years, and so I know your background. Would you mind talking a little bit about your background for?
Yeah, I grew up in South Florida, where I now live again. We were based in New York for the majority of the company's founding, but we decided a few years ago to make the move to Miami. Went to Rutgers, always been super entrepreneurial. Um, Worked with some people over the years, and kind of financial services and startups. I was involved in a startup while I was in college. That I got to see the birth, life, and death of a startup from my dorm room, which was
Yeah.
an amazing experience. Um, and then back in 2006, I saw an opportunity within New York to do early stage investing. There really wasn't much of an early stage ecosystem like there is today. There were a handful of funds. They tend to be later stage funds that would apply the same diligence and rigor to the investing process for a $20 million check or a $5 million check to a $500,000 check. And, a company that's raising 1 million, 2 million, 3 million doesn't have the same data points. So it's a very different diligence process. So we saw the opportunity. The ecosystem was very nascent at the point, and it's been kind of a wild ride ever since.
Yeah. But I know that we've exchanged stories about that wild ride, and I'd imagine that with the sort of the earlier stage focus, there's probably more of a focus on the founders as opposed to like other types of metrics, for example.
Yeah, I mean, I jokingly say it's 97% people,
Yeah.
uh, 2% market, 1% product.
Yeah.
Obviously, that's directionally correct.
Yeah.
Don't hold me to that, but yeah, it's a people business. Companies are collections of people, and people create the IP within companies. So we're really looking for founders that we want to partner with on the long run, because you know, unfortunately, there's no such thing as an overnight success.
Yeah.
The overnight success only happens after a decade of hard work.
Yeah.
We've got companies in the portfolio that are 15 years old at this point and still haven't, exited, or still building,
Yeah.
still exciting.
Yeah.
But it is a long journey when you invest in a company, and this is not a quick hit business, to say
Yeah.
the least.
As an early stage investor, are there maybe different types of ways you can help companies versus like something that's a little later stage?
So, at the early stage for us, it's all about building the product, which I think is significantly changing right now. And it's all about, how do you really find product market fit, right? So how do you get in front of the customer as quick as you can to really understand what their needs are, not to build in a vacuum, and not to assume what they want, but at the same time, making sure you've got a broad breadth of customers giving you feedback, so that you're not building in the direction of what one customer wants, which we see that happen a lot. A company will, a large Fortune 500 will approach them that they want something, and they get super excited, and they go down this rabbit hole of building technology, and then they only to go out and realize many other companies didn't have that need. So it's really about, listening to the customer. It's not just the customer, and getting a broad base, and building a product. And I think very much like giving a founder and the founding team an outside perspective, and holding them accountable, right? And when I say holding them accountable is, you know, providing the skepticism, right, to ask the tough questions to ultimately make the company succeed. Like, we're all in it together. We want to succeed. We want to be on the right path.
Um, I'd imagine that having been in VC for quite a bit of time now, like you can look back at it. Are there things that before you got into VC, and now that you've been in VC for this decent amount of time, like what were the maybe some of the biggest surprises or myths that about VC?
Yeah. So at the early stage, and that's my perspectives, how service oriented the business is, how not scalable the business is, right? The irony is, we want scalability. Yeah,
Yeah.
we're not scalable,
Yeah.
right? Our businesses. So, and how much of a focus is on people and how a top founder will take a B idea and make it a home run,
Yeah.
and a B founder will take a top idea and make it a failure,
Hmm.
right?
Hmm.
So it's so much about the people. We've all seen companies where the product's not great. There's a better product out there.
Yeah.
It looks better. It works better. It's got more integrations. It's got more, flash to it.
Yeah.
Yet this other company is just killing them,
Yeah.
right? And because they just have a different grind, different grit approach. So that for us, it's so much about backing the right people,
Yeah.
and that's hard, right?
Yeah.
Because the only thing for us, that you can determine if you're backing the right person is time.
Yeah.
So we try to really get to, prior to investing, get to know the founders,
Do.
uh, get to understand their approach, how self-aware they are,
Yeah.
where their strengths are, where their weaknesses are they going to be able to fundraise?
No.
Those are all the kind of soft skills that we really look for.
I'd imagine that type of pattern recognition or matching is very difficult because, like, I think you've invested in quite a broad range of industries. And, like, how are there beyond time, like, do you call upon your past experience,
Uh,
or like what?
100% there's pattern recognition in founders, right? Like, you know, and different characteristics might lead to different outcomes, right? We try to back founders that are super self-aware, founders who are really understand and have a passion and for it, and founders that realize this isn't going to be fun, right? Like there was and I don't think it's as much as there was, but there was a period of time where being a founder was super sexy, right? It was, getting the blog post headlines, and I don't think they realized how difficult it was,
Yeah.
right? And getting that headline that you just announced your Series A or Series B is not the win,
Yeah.
right? The win is when you have a real business that's operating, can help generate wealth for your employees, help your customers improve. That's the win, not,
Yeah.
I raised $30 million at a $150 million valuation, whatever it might be.
Yeah.
And unfortunately, our industry has kind of went there. And there's also, I think, this piece of this killing it mentality
Yeah.
within our world where, as a founder, you've always have to be, putting on this persona, fake it till you make it type persona, where, and that's just not good. So we really try to work with our founders kind of much more on a one-on-one level to like understand that this isn't, it's going to be an up and down, right? Hopefully the trend line is this way, but don't think it's going to be this, even though we all want that. Like that's also like the dichotomy of venture versus founders. Like as a investor, you've got a fund that's got a portfolio of companies. As a founder, you're one of one. You have zero diversification, right? You are in that company. As an investor, I've got a ton of diversification. If one company fails, hopefully, two others succeed, one other succeeds, whatever it is. So as a founder, like you got to realize that, right? From when you're taking on your investors, you're 1 of 20, 1 of 30, 1 of 40 in the portfolio, right? And they're searching for returns for their investors, right? And that's super important for the industry to sustain itself.
I love that. And I love the fact that you're the authenticity and like the straightforwardness. I think is that sounds very, like, really, really cool. You having been in VC for 19 years now, like, how's VC changing?
So it's always evolving in different ways. I think we're at a interesting juncture right now where I don't can't predict the future, and what's driving that is AI. And if you look historically, a company will raise money to build a product, right? So they'll raise their first round of funding, whatever that is, pre-seed, seed, whatever you want to call it. It's constantly changing. To me, it's your first $2 to $2.5 million, and 75-80% of that will go to building the product, right? And then 20% of that will go to sales and marketing. So it's kind of like an afterthought, right? So historically, you raise this money, you hire a bunch of engineers, maybe some of them, here in the US, maybe some of them international, maybe some employees, maybe some contractors, whatever it is, 75% of that capital is going to that, right? And then you build, hopefully, like not in a vacuum, so you actually hear from some customers, but you're building for 6, 9 months, a year, year and a half, whatever it is, and then you're ready to go to market, and you've left yourself relatively little runway, right? Because you've got this engineering cost, right, team that's non-revenue producing. So maybe you have 5 engineers, 6 engineers, 1 or 2 sales people, if that, right, who now have to like support this business, show revenue ramp, so you can go out and raise your next round of funding. Where I think things are changing is a lot of the new AI development platforms are incredible, right? The efficiency they're creating, the ability to work with third-party firms that are leveraging these platforms, and in a very inexpensive way, develop a product that I'm kind of calling a pretty good viable product. That's enough to take out to market, right? And I think instead of having to spend 75, 80% of your funds on this, you can spend 10% of the funds, 5% of the funds, 20% of the funds, a lot smaller, leaving a lot more capital to actually go and do sales and marketing, right? So the question becomes, if you need a lot less capital to build, right, because of these development platforms that are out there. And look, I'm not saying these development platforms are going to scale you to $100 million of revenue, but if they get you to 10 or 12 or 15, that's a high class problem, right? At that point, you figure out how to rebuild, you figure out what you need to do to make it scalable to the next level, right? So you're going to be able to go out there much more cost effectively and figure out product market fit than you ever have before, right? And on the other side, and it's early days, what does AI do for sales and marketing, right? So are we all of a sudden able to build companies that maybe we had to raise $2 million, $3 million to get to kind of that first big milestone of ARR for 500,000, right? Well, what does that do to venture, right? That's the questions we're asking, right? Ultimately, our product is our capital, right? We're providing, we're providing services, and there are funds that have platform, that'll help with your HR, will help with your accounting, will help with your social media, but one of our core products is, besides advice, education, support, capital. If all of a sudden founders don't need as much capital anymore, what do we have to sell, right, as an industry, right? So that's the big questions we're asking right now. Like, what does venture look like with the AI? Now, I think there's a ton of opportunity right now in venture for a lot of these AI technologies, and we're seeing a ton of money go into that, right? Like, unfortunately, right now, we're seeing much more concentrated capital in the industry. So a lot of capital going into few deals, right? Versus a distributed, which is tough for founders also to see, right? So there's definitely going to be, it seems like there's more haves and have-nots now than ever before.
I know that you attended Fintech Meetup this year.
I did.
Can you talk a little bit about your experience there?
Yeah. So it was part of an 8-day trip in Vegas. So I don't recommend 8 days to anyone in Vegas, but it was excellent. So what I liked about it, besides the pickleball court, right, was I liked the 15-minute meetings. For me, they were great. I got to meet probably 12 to 16 founders over that period of time. They were the good length, right? So I'm not going to make an investment decision in 15 minutes. And as a founder, you shouldn't take capital from someone after meeting them in 15 minutes. You should want to get to know them as much as we want to get to know you. So the 15-minute sessions were great for me and the founders, because it was enough to see, okay, is this a fit and worth a follow-up conversation? So I think the structuring around the platform, setting up the meetings, this is my first one, so I didn't realize the importance of that, but now I saw how important it was. I thought that was fantastic, where, if you're going to this event as a founder, really invest the time in going through that platform and finding the right fits, right? It's like, one of the nice things about it is a lot of conferences have great content, which Fintech Meetup had also. But there's the networking is much more through parties, through walking the floor. Like that doesn't work for everyone, right? Not everyone is very outgoing. Not everyone is going to go and network like that or wants to go to the parties till late at night and walk up to someone randomly and say, "Hi, what do you do?"
Yeah.
So the forced interaction, right, was I think incredible for people to ensure that they go and they leave with, you know, high value connections, whether that be an investor, whether that be a potential colleague to join their company, whether that be a sales lead, right, a potential partner. So I think for me, like, you know, the content was great. I listened to a bunch of it. I went to some of the pitch sessions, but I think from a founder's perspective, like the fact that there's this environment that really facilitates the meetings for whatever they want, it was excellent.
That's great to hear. That's great to hear. And what advice would you give to someone who's going to join next year?
Yeah, I would say go to Vegas, just not for 8 days. That's the first advice. But really invest in the platform that you guys have to identify the right meetings. Put the legwork in up front, and the rest will be easy, and you'll see a lot better outcome from meetings, right? If you put that effort in, you're going to get the results you want, right? It's kind of like a sales process, like qualify those leads, right? You guys are dumping a lot of leads in front of everyone, right? Like go through and qualify them for the right ones and connect with them.
And that's great advice. And you know, as we close off, like I wanted to ask you, you know, what are you excited about? What get like looking out ahead?
Yeah, I mean, we're super excited about what venture looks like in the future, right? What uh, how AI is impacting it. I think we're super excited that now is a great time to start businesses, right? Because the cost of entry, for lack of better words, is falling so quickly. The technology is evolving. So I think we're going to see a lot of businesses that are coming out and super focused on the customer and sales and marketing. And I think that's exciting. Now, there's still question marks about what it means for our industry, but we're okay with that.
That's great. No, that's a great way to end this talk.
Awesome.
Thanks for joining us, Jay.
Thanks for having me. I really enjoyed it.